You are in your 30s, you have some money saved up, and you are staring at two paths that could completely change your financial future. One path pays you cash while you sleep. The other quietly grows into something massive in the background. And the question that nobody in your family ever taught you how to answer is this: which one actually makes you wealthy by the time you want to retire? Today we are breaking down dividend investing versus index funds, and by the end of this video, you will know exactly which route fits where you are trying to go. Let us start with the reality of being in your 30s right now. You are not a broke college student anymore, but you probably are not swimming in cash either. Maybe you have a mortgage, maybe you have kids, maybe you have a career that is finally starting to pay off. The point is, the decisions you make with money in this decade carry more weight than almost any other time in your life. You have enough time left for compounding to do serious work, but you also cannot afford to waste the next 10 years on a strategy that does not match your goals. So let us get into it. First, let us talk about dividend investing. The core idea here is that you buy shares in companies that regularly pay out a portion of their profits directly to shareholders. Think of it like owning a small piece of a business that cuts you a check every single quarter, just for holding it. These payments are called dividends, and some companies have been paying and even growing those payments for decades. The emotional appeal here is real. There's something deeply satisfying about watching money land in your account without selling anything. It feels like income. It feels like progress. And for people who are anxious about the market swinging up and down, that steady cash flow can actually help you stay invested instead of panic selling. But here's where it gets interesting. Dividend investing has a trade-off that most people do not talk about. When a company sends that cash to you, that money is no longer being reinvested back into growing the business. So often, high dividend paying companies grow more slowly than companies that keep all their profits and plow them back into expansion. That matters a lot over 30 years. Now let us flip to index funds. An index fund is basically a basket that holds a massive slice of the market. When you buy into something like a total market index fund, you own tiny pieces of hundreds or even thousands of companies all at once. The cost to you is extremely low because no one is actively picking stocks. The strategy is simple. The market grows over time and you grow with it. Historically, broad market index funds have delivered strong average annual returns over long periods, and the data consistently shows that most actively managed funds and individual stock pickers fail to beat them over time. The power of index funds for someone in their 30s is in pure wealth accumulation. Because those companies are reinvesting their profits rather than paying them out, you get the benefit of compounding on top of compounding. Your gains produce gains. Your growth grows. Over 30 years, that snowball effect can be genuinely staggering. So which one wins? Here is the honest answer. It depends entirely on what you actually want your money to do for you. And this is where most financial content fails people, because they turn it into a competition when it is really a conversation about your life. If your primary goal is to build the largest possible nest egg by the time you hit your 50s or 60s, the data leans heavily toward index funds. Lower fees, broader diversification, and the full power of compounding. Working in your favor, make a compelling case. You are not trying to create income right now. You are trying to build a mountain of wealth that you can eventually draw from. But if your goal is to eventually replace your income with passive cash flow, to reach a point where dividends literally cover your bills so you never have to sell a single share, then dividend investing has a real and meaningful place in your strategy. Some people find that owning dividend-producing assets gives them psychological safety that keeps them from doing the wrong thing when markets get scary. And doing the wrong thing at the wrong time is genuinely one of the biggest destroyers of long-term wealth. Here's what most people in their 30s actually do, and honestly what makes a lot of sense. They do not choose one or the other. They build a foundation with low-cost broad market index funds to capture that long-term growth engine, and then they layer in dividend-focused holdings over time as they move closer to wanting income, rather than just accumulation. Think of it as building wealth first, then gradually shifting toward harvesting it. The trap to avoid is chasing yield. Some investments advertise very high dividend payouts, and that can look exciting. But a high yield that is not sustainable or comes at the cost of poor growth is not actually serving your long-term goals. Quality matters more than the size of the payment. What you should do right now is get clear on your number. What does your life actually need to look like financially in 20 or 30 years? What monthly income would feel like freedom to you? Work backwards from that number, and then ask yourself whether your current strategy is actually building toward it. The beautiful thing about being in your 30s is that you have time. Time is the most powerful financial asset you own right now. More powerful than income, more powerful than a hot stock tip, more powerful than any single investment strategy. The worst thing you can do is spend the next few years overthinking this instead of simply starting and staying consistent. Both dividend investing and index funds can build serious wealth. The one that wins for you is the one that matches your goals, keeps you invested through the hard seasons, and compounds long enough to do its job. Now go make a decision and stick with it. Drop in the comments which route you are leaning toward, because your answer might just help someone else watching this figure out their path too.